This is Marshall Gittler, Head of Investment Research here at FXPRIMUS, bringing you my daily comment for Wednesday, December 16th. Now, I mentioned that while the market is expecting the FOMC to hike interest rates today, expectations for the future path of rate increases is much more modest than what the committee members are predicting. In fact, the forecast may be discounting the possibility that the Fed might even have to stop hiking and start cutting again, perhaps launching quantitative easing 4, QE4. The reason why people might be thinking such a thing is because of what's going on in the U.S. corporate bond market. Some U.S. corporate bonds have collapsed recently, and several big bond funds have had to close. That reminds people ominously of what happened in 2007, when the collapse of the mortgage-backed securities market led indirectly to the big stock market and economic collapse of 2008. Investors didn't worry too much about the fall in mortgage-backed securities in the early stages, but later the rot spread to the broader financial markets, and we all know how that story ended. The culprit this time is quite clear: energy companies, particularly the smaller, more speculative issues. Many of these companies are in the shale oil business or linked to it, and the collapse of oil prices has hit them hard. This time around, though, while the fear may be there, the reality is much different. Banks and security firms have much smaller positions in these securities, so even a major sell-off wouldn't have the same implications for the entire financial system as it did back then. However, it's also true that nobody then foresaw the linkages and connections throughout the financial system. People are worried that this sell-off, too, will have wider implications that we just can't foresee yet. The implications for the currency markets, the developments in energy bonds, are bad news for all the energy-related currencies, but probably most negative for the Canadian dollar. There's been a close correlation between the movement in energy bonds and the movement in dollar CAD. Of course, that may be part because both are correlated to oil prices, but also getting oil out of the Canadian oil sands is a high-tech process, as is developing shale oil. So the carnage in this industry is bound to hit the Canadian dollar more than the Norwegian krone, for example, where the oil is produced by huge offshore drilling operations run by energy majors. In a similar vein, fears of a decline in market liquidity may hurt the Australian dollar, as it could cause a risk-off environment that would particularly be harmful to the Australian dollar. The downturn in U.S. credit markets may be dollar negative as it increases risk in the U.S. markets and may encourage outflows from the U.S. and into Europe, where the ECB is the buyer of last resort for the bonds. Ultimately, a major meltdown in the credit markets could cause the Fed to halt the process of normalizing interest rates and even reverse it, which would definitely be dollar negative. But that's still in the realm of speculation. We'll have to see if the carnage is contained in the U.S. high-yield energy market or if it ripples through other markets and the greater financial system. It's one of the major risks to watch out for in 2016. This is Marshall Gittler, Head of Investment Research at FXPRIMUS. Get more market insights on our education pages and turn your trading ideas into action with FXPRIMUS, the safest place to trade.